Good afternoon and thank you for joining us on our regular Friday Finance Masterclass. Great to have you here, and if you're watching us live, hello, and if you're catching us up over the weekend on replay, then great to see you here. Right, so as always, please let me know that you're here. Drop a comment in the comments field below, give me some likes, and please ask any questions you've got. And if anything I say you need some further explanation on, or you've got an aha moment, please do share that in the comments as well. And because the way I'm filming today, I can't actually see the screen, so I'll be checking it on my iPad as we go, so please do let me have your comments there. And if you're watching us later on replay, hashtag replay, just so I know you've seen it. It really helps me to know who's watching these things and to know that you're finding these useful. Of course, that's if you are. If you're not, let me know, and let me know what you'd like to see instead. Right. Today we are talking about be the boss of your balance sheet. This is a really important topic for any business owner to master, because it's something that usually we kind of leave to the accountant, and it's something that we're usually not that confident about. So today I want to really dispel all those myths for you and help you to feel really confident and inspired to go and look at your balance sheet and to really use it to help you in achieving your financial freedom. I'm just going to check and make sure we are live and I'm not talking to myself. I can't see anything yet. Hopefully, well, yes, there we are. Wonderful. Carl, I can see you there. Fantastic. Good to see you. Carl and Yvonne and Julie, hello. Great. I'm glad you're there. I'm glad I'm not talking to myself. Fantastic. Hang on. We don't want that playing at the same time. Bear with me. Don't want the video playing while I'm talking. Right, okay, back with you. Apologies for that. So, here's the thing. If you are thinking in any way, shape or form that you don't get your balance sheet, I want you to know that you're in very, very good company. I don't think I've ever worked with a company in the last 20 years who has felt confident with their balance sheet. So don't be afraid to kind of ask questions or to say what you find confusing. And I think I'm seeing a common theme in this group where people are thinking like, I think I'm supposed to know this stuff, so I don't really raise my hand and say I don't. I really want you to know that most small business owners don't understand their finances, and that's what I'm really here to help you overcome. So don't be shy in kind of saying what you find confusing about this, because this is really where we're going to learn and break down those barriers. So the balance sheet is pretty much, I think, the most feared and misunderstood part of business finance. And it's something that people just tend to go like, leaving that to the accountant, don't get it. Now, the thing is, as I've talked about before, finance and money really are the language of business. So as business owners, it's a critically key skill for us to say, I'm going to learn this, because once I can speak the language, I've got far more chance of being able to achieve financial freedom. And if financial freedom is your motivation, then we need to understand that financial part of it, because it's all these small things that we do in our business that are going to really move the needle and make the difference for us. So when we look about the balance sheet, it's important because without it, you are not seeing the whole picture in your business. So I've drawn a beautiful diagram here, which I'm sure you'll agree is spectacular. And what we want to see is we've got a profit and loss, we've got the cash flow, and then we've got the balance sheet, and they are all interlinked. They do not exist without each other, and the balance sheet is the key thing that links them all together. So if you are just running your business looking at your profit and loss or at your cash flow, you are missing the pin that holds it all together, because the profit and loss will tell you what profit you've made this month, this year, last year, and that's fine. We need to know the profit and loss. We talked all about that last week. Very, very important. Cash flow, of course, critically important. Without cash, we've got no business. But they're not the whole story. Neither of those things tell you where your business stands right here, right now. They don't tell you the health, the strength, and the wealth of your business. They are things in isolation. In the same way the balance sheet won't tell you about whether you made profit this month or if your gross margin was right. They are interlinked and must always be used together. Without them all, without that trinity, you are not seeing the whole story in your business. And a business is too finely balanced and too challenging for us not to know all of it. We can't just be looking at one or two parts of the business. Okay, so what is then the balance sheet? And I'm not going to go into the accountancy world about this because that is not helpful, and that is not going to help you, the owner of your business, take control of it. So it's really time today for you to intuitively just get what this means now, rather than trying to remember some kind of accountancy explanation or definition. Fundamentally, it is the health and wealth of your business at a given point in time. So whereas a profit and loss will cover, say, a trading month or a quarter or a year, a balance sheet is a snapshot in a moment of time. It will usually be a month end or a year end. And remember what I think about quarterly accounts? They should be illegal. So if you're only getting a quarterly balance sheet, like the quarterly accounts, not enough. So push back and get monthly. So it's the health and wealth of where you are at a moment in time. And it's fundamentally what you own, what you are owed by other people, less what you owe out to people. And that is all balanced off by the amount of money that you have ever made and kept in your business. So we call that retained profit. So the bottom line of your balance sheet is the amount of money that you've ever made and kept in the business, plus any share capital from when you started the company. And usually in a small business, that's normally like a notional £100 we put into share capital. So really, when you look at your balance sheet, it's fundamentally the amount of profit you've ever made and kept. And that's what it means. Which is why I bang on so much about making that 10% minimum retained net profit and keeping cash in your business, because this measures our strength. It measures the wealth, the health and the strength of our business. Now, the accountancy version of that is it's your net assets, which means it's the value that your assets would be worth if we were to sell them all today. It is a key measure of your solvency. Now, and especially in a time like now where there's so much volatility in business, the solvency of your company is critically important. It's also a legal thing. So it is illegal for anyone to trade if their business is insolvent. And by that we mean unable to pay your bills as they fall due. Now, a negative balance sheet is a key definition and measure of insolvency. So really important, you can see, to see your balance sheet every month, especially if you're making losses at the minute, because if you tip into negative balance sheet, you've got to go and get professional help or you risk being prosecuted. I'm not trying to scare you, but I do want you to realise just how critical it is for you to know your balance sheet. Now, your balance sheet is not your business value. They're two very different things. Now, a lot of people get confused with this and thinking my balance sheet is my value. Your business value would be what somebody else will be prepared to pay for it. So if someone came, hey, I like your business, I want to buy it, they're going to pay more than your balance sheet value, because they're going to pay for your customer base, your intellectual property, your goodwill, your recurring profits, your recurring revenue streams. So your business value will usually be more than your balance sheet value, unless you're selling in distress, of course, and then you can expect it to get different. But it's still nonetheless an incredibly important number, because it is the statement of the wealth of your business at a moment in time. Now, I call this the moving to Australia figure. So just supposing you said, do you know what, I've had enough of this, I'm going to emigrate to Australia, I'm selling up, I'm going to sell the house, I'm going to sell the business, or no, I'm going to shut down my business. Key difference, I'm going to shut down my business, I'm going to sell off my assets, I'm going to pay everybody off, collect all my debtors in. The amount of money you would have left at the end of doing that, so if we liquidate today and we get what things are worth, that figure is your balance sheet figure. Okay, so think of it in useful, sort of helpful, friendly terms. It's that moving to Australia figure. What will I get if I liquidate, if I sell everything up today? Hope that's clear. Please let me know in the comments if there's anything you need to know on that. Excellent. Right, so I said before, most people abdicate this stuff to their accountant. They go like, oh my God, balance sheet, don't understand. I leave all that to the accountant, I leave all that to the bookkeeper. Maybe I look at it at year end when the accountant makes me sit down and go through it, but I just don't get it. So let's just unpack a bit why people abdicate their balance sheets, because I totally understand why, I really do. In fact, my previous accountant used to insist on talking me through my disclosure notes, which was really unhelpful, and there was no way it was going to help me run my business better. So I get why it can seem a bit dry and uninteresting. Now, the main reason we do that, it's full of jargon. It's full of words we don't really understand or don't really use day to day in our business, like, I don't know, deferred tax provision and appreciation, accumulated depreciation. All of these things are designed by accountants, and sometimes your accountant quite likes the fact that he or she are the only ones who understands that stuff. Not everyone is open in wanting you to fully understand and embrace your balance sheet. It can seem quite complex, and they can use language on your balance sheet that feels quite difficult to interpret and understand. So again, what we do with our clients is we put our balance sheet into English so that they're words they can relate to. It's like when you're looking at debtors and creditors, people always get those confused. Well, we put debtors dash customers, what your customers owe you. Creditors dash what you owe to your suppliers. Making sure that your balance sheet is in English. So if you have that challenge, don't be afraid to push back with your accountant and say, can we just use words that I can actually understand? Because it is your balance sheet and it is your money. It's not theirs. And just the lack of understanding of a balance sheet means that we're not going to look at it. Why would we? We're busy. We're not going to sit and stare at a document. We have no idea what it means. And also there's usually no context. Often you're just given a printout with a single column of figures. Maybe it's compared to last year. If you remember last week in the profit and loss masterclass, I talked a lot about context and comparison. You've got to be comparing your balance sheet in the same way so that you can see trends, you can see how things are changing and moving. Without that, it's pretty uninteresting and pretty difficult to read as well. And then of course there's the I don't know what to do with it. I've got my balance sheet, but what do I do with it? How do I use it? So we just don't use it, of course. We kind of know what to do with the profit and loss, or certainly we should after last week's session anyway. And it just feels like an accountancy kind of thing. Something that's not for us, it's for the accountant. It's a line we don't cross, we just leave it all to them. Now, for the reasons I mentioned before, it's about your money, your wealth, it's about the solvency thing, which you're legally liable for. These are reasons why we cannot afford to abdicate our balance sheet to anybody else. It's something we have got to own as the owners of our business. So, I want to talk you first through a personal balance sheet, because I think once you can see how it relates to your personal position, I think that will help the penny drop in terms of exactly what the business balance sheet is doing as well. So we start off, and I've used the same structure as the normal balance sheet, but just to really explain what these things are. We start off with fixed assets. So this is stuff, physical, real stuff. So this will be things like your house, your car, your furniture, or your technology, gym equipment, television, all those things. Also including things like your pension and your investments, because they are assets. And the definition of fixed asset means that they're not liquid. By not liquid, I mean we can't turn them into cash quickly or easily. So you could sell your house, but you can't sell it next week to pay the food bill. You can't turn that money into cash on a quick basis. So they are what you call our fixed assets. They are our long-term assets. We then have our current assets. So these are things that we can turn into cash very quickly. So for a personal situation, that's really going to be what you've got in your bank and what you're carrying in cash. So we're thinking liquid, if we need to pay a bill, where we get the cash from quickly to do that with. We then have our current liabilities, and this is basically debt. So this is current, and this means it's due in the short term. So this isn't stuff like the mortgage, this is stuff that we owe short term. So it could be things like a bank overdraft, any credit cards, any other short term loans that you might have. So they're things that you've got to pay out in the short to medium term. We then go into long term liabilities, which again is debt. And this would be things like your mortgage, any car finance, or any other long term bank loans, or maybe HP, those kind of things. So you can see those things. And then when we add up all of our assets, and we take off all the things that we owe out, we end up with our personal net worth. Now, in the Academy, we actually do a monthly process. We all actually track our personal net worth along with our business net worth so that we can see our pot to financial freedom and how that's building. So this would be, again, the moving to Australia figure to a degree. If you're going to sell your house and sell your car and pay everything all off, how much money will you have? And we call it, the net of our assets and our liabilities. So the stuff that we own, less all the stuff that we owe out to people. So hopefully that makes sense. Shall we see if there's any comments? No. Please don't be shy with the comments. If you've got any questions at all, please, this is the time to ask them. So now we move on to the business balance sheet. Same structure as we've seen before. We have fixed assets, current liabilities, long-term liabilities, and then the bottom line we call here capital and reserves, which you may have seen on your balance sheet before. So let's talk through what goes into each of those things there. In fixed assets, remember these are things that are not liquid, things that we can't sell quickly or easily. premises, if you've got business premises, plant, machinery, equipment, computers, all those kind of things, your printers, any of the tech. Also, sometimes you can put your website on there if your website is a business asset that you use to generate income. And goodwill. A goodwill is where you maybe have bought a business or you've bought something in there and there's a goodwill element of that purchase. That all sits in fixed assets because something like goodwill is a very accountancy thing. It's not something we can sell quickly if we wanted to raise money. Current assets, again, these are things that are more liquid and that we could convert into cash quickly if we needed to. And when we talk about working capital, it's very much this cycle of current assets and current liabilities that circulate round, hopefully quickly enough that we can turn that cash into money to pay our bills with. So current assets, we're looking at things like stock, because stock you'll be hoping to be turning it round and turning it into cash within a 1, 2, 3 month period, or as quickly as you can. Work in progress, which is work that we have done the work for a customer, but we haven't yet invoiced them for it. So again, we're going to be turning that into invoicing and cash very quickly. Obviously, bank and cash fall within there. Debtors, which is what our customers owe to us. Again, they're going to be paying us in the next month or two, so turning into cash quite quickly. We've then got prepayments, which again is another accountancy thing. But prepayments means, let's say if we had an annual rates bill in, we don't want to put all of that rates bill into our profit and loss in 1 month because that will just give us a great big cost, and we want to smooth it out across the year. So the prepayments in the balance sheet is where we put the rest of that money that we haven't yet booked to our profit and loss, and we push that back in the balance sheet. So it's not really something that's going to turn into cash as such, but it's certainly something where I guess if you were to leave your premises, you would get a rates refund. So to that degree, it would turn back into cash. And things like director's loan. So if there's money owed, so if you owe money to the company, so if you've borrowed money from the company, your director's loan would sit in there in current assets. And again, it's current because usually you want to pay that back within the year, otherwise you're going to get a tax bill on that figure. And that's getting quite onerous, that tax, so we don't really want to be owing money to our companies. Current liabilities, again, short-term debts, short-term things that we owe out of our business. Things like a bank overdraft. If you've got invoice discounting or factoring, that would be in there too. Creditors, which is what we owe to our suppliers. Credit cards, so your monthly credit card bill from the company. Director's loan, if you are owed the money. Now, sometimes when people start a business, they put a lot of money into the company at the start and then they take it back out over time. That sits in there. Obviously, your VAT balance, so your VAT balance that builds up every quarter, your PAYE from your monthly payroll, and your corporation tax. Now, corporation tax is where one of the black holes in your balance sheet might be, because unless your accountant or bookkeeper is doing a monthly corporation tax calculation, your balance sheet is going to look better than it really is. And we'll talk about on the next page when I talk about holes in balance sheets, because that's something that can catch a lot of people out. And then we've got accruals. So accruals are another accountancy thing, and that's where if you've got missing costs in your month, let's say you had a stock delivery at the end of the month and you never got your invoice in on time, we put like a dummy invoice in and we call that an accrual, just to make sure we're recognising that we actually have had a cost for that and that we do owe someone some money. And what would happen is, as we get the invoice in, that liability will move from accruals and it will go into suppliers. So again, that's just a way that the accountants use to make sure that all the costs are in the right place and that we are truly showing all of our liabilities. And then we've got the longer term liabilities here. So things like long-term bank loans, hire purchase, those kind of things. So those long-term debts. And it could also be mortgages on your property if you've got commercial property. When you add all of these things up, so add your fixed assets, add your current assets, take off your current liabilities, take off your long-term liabilities, and this is the magic of double entry bookkeeping, which is quite geeky, but it is quite interesting the way it works. That then magically equals the net of all of the profit you have ever made and kept in your business since the day you started trading, plus any capital that you have. So we talked about that before. That's the capitalisation you did when you started, often that notional £100. Some people do capitalise more for tax reasons. But all of these things, they balance exactly to basically the amount of profit you have ever made and kept in your company. So when we look at our bottom line, we talk about the bottom line of your balance sheet, the bottom line of your business, we mean this. The bottom line is usually the amount of money that you have ever made and kept, so that you've not paid it out in dividends, it's not got out in tax, it's the money that we've got left in the business. Now that definition often really surprises people and really helps them to go, Oh yeah, that really makes sense. I just totally get that now. You know, the bottom line of my balance sheet is basically my profit figure, the profit that I've ever made. And can you see now why looking at your profit and loss on its own doesn't tell you the whole story? Because this is telling you the profit you've ever made. So it's a big figure to know. Okay, so remember, context and comparison. Talked a lot about this last week. It applies to our balance sheet just as equally. And this is where we don't want to see just that single line of figures, which doesn't really tell us much, because if I tell you VAT was £20,000 this month, well, that's fine, but what was it last month? What was it the month before? If I tell you that the bottom line profit figure is £150,000, again, it's fine, but where's the comparison? And the big important thing about the balance sheet you want to be looking at is that bottom line figure, is it going up? Because what happens with your balance sheet, and one of the nice little magic things about it is, when you look at the bottom line of your balance sheet month on month on month, it will move by the amount of profit you made in the month. So the connection between the profit and loss and the balance sheet, whatever profit you made, your bottom line will move by that amount of money. So it's another really good way of making sure it all stacks up and makes sense. So in an ideal world, we want to see that lovely bottom line going up every month, every month, every month, adding, creating more wealth, creating more health and strength in our businesses. So remember, with context and comparison, without this comparison, it doesn't mean much. And it's also really important for spotting if something is wrong, because guess what? It's very easy to make mistakes on the balance sheet. It's very easy for accountants and bookkeepers to make mistakes on things, and you need to be paying attention to this, because when things go wrong, they can be quite serious for a business. Oops, excuse me. So, should we just leave it all to the accountant? I think you'll know that my answer by now is absolutely, categorically, totally no. And it's not because we don't trust our accountant, but it's because it's not their money or their business, it's ours. And we can't assume that anyone else is ever going to care as much about our money and our future as we do. So it's really important that you own this. And there are some other reasons why. And these are, I've been doing this for 20 years now, and I have seen some horrific, truly horrific, dangerous things happening in bookkeeping and by accountants. And I'm not bashing accountants, I am an accountant, but we've seen some really horrific things done over the years by accountants who really should know better. And the consequences for you as the owner can be very serious if there's a mistake on your balance sheet, and because when it corrects, guess what? You could sue them, but it's not their business that's now in trouble, it's yours. So it's your wealth, not theirs. I want to make that so clear to you. It's no one else who you abdicate this to or trust this with will care as much as you do. And also, you're going to see things because you know the numbers. It's your business. You know what's going on in there. We can end up very easily with black holes on your balance sheet. Now, this can come from poor bookkeeping, and this is very common, probably even more so now with the advent of automated bookkeeping, because we're fed this myth that things like Xero and QuickBooks, they just do it all for us like magic. And it's not true. They may physically import the transactions, but knowing where to code them and how to treat them is a skilled job, which is why, you know, you should still have your accounts checked by someone who knows what they're doing. Because a bookkeeper or even an admin person putting those things through, that doesn't mean they understand accounts, and the accounting package doesn't know it all. It can't do it all for us. So we can see things like poor bookkeeping, things not being reconciled properly, and we can end up with black holes on a balance sheet that can actually end up being fatal to a business. I don't mean to sound scaremongery there, but I've seen it lots of times over the years. And it's things like the corporation tax that I mentioned before. If they've not put this year's corporation tax bill in, and again, if you are waiting for last year's accounts and it's been maybe 3, 4, 5, 6 months, they won't have put last year's corporation tax bill on yet either. So you're merrily going along thinking your balance sheet's one thing, and you may be making investment decisions, you may be making all sorts of decisions to take on debt maybe. And then guess what? And I'm sure you've probably mostly had this experience. You get your balance sheet through and guess what? It's dropped through the floor. You thought you were here and now you find out it's here, and you're going like, what the hell happened here? And it's because they didn't put their year-end adjustments through. Now, year-end adjustments, while we're on the subject, if your books are being maintained accurately throughout the year, you should have very little year-end adjustments being made at all. So if you do find you've got lots of adjustments going through, there is a problem. there is something wrong and you need to take action on it. It's most likely that your bookkeeper doesn't know what they're doing, or they're doing the very basics, and the accountant's got to do lots of wash up at year end and lots of changes and lots of adjustments. Now, the balance sheet, I strongly believe the balance sheet should be audit quality all year long, because it's so critical. It is literally the statement of our financial position. So if you're waiting all year and suddenly someone wipes a load of value off because they've put the year-end adjustments through, it's just not helpful. So we need to have accurate books all the time, because our balance sheet feeds off it. And it's all well maybe knowing what your profit figure is, but if they wipe a load of profit off at the end of the year, that profit and loss meant nothing. In fact, I've got an example here for you. A client I worked with a few years ago, they had a bookkeeper who was doing all the bookkeeping and managing the payroll, and the boss was getting the profit and loss every month. Great, fine, absolutely lovely. Thought he'd made £100,000 net profit, made a decision to go and buy a building on the back of that. When the year-end figures got done, he'd actually made a £20,000 loss because the bookkeeper hadn't put any payroll journals through. Now, had he been looking at his balance sheet, he would have seen that there was something very wrong. Because if he's got too much profit over here, there was something on the balance sheet that was going to show up an equally big problem, because he was building this big wage creditor in the balance sheet. So there is always an equal and opposite effect. If there's something wrong in the balance sheet, there's something wrong in the profit and loss most likely as well. There's always an equal and opposite entry to every problem. So there are just many reasons why black holes and poor bookkeeping can leave you with a balance sheet that is not true, and you're going to get a shock at year end. And I don't want anyone to get a shock at year end, because it's a horrible feeling. You thought you were at one place, you find out you're somewhere else, and it can actually put you into danger. So very important that you know your balance sheet is correct. And again, we come back to this solvency issue. If your balance sheet isn't correct all the time, you won't know for sure that your business is solvent. I mean, you may know, you may be making fortunes and you may know for sure, but if things are a bit close at the minute, maybe you've made making losses, knowing that solvency figure is so important. Another area is also directors' loans. So again, bookkeepers who aren't quite sure what to do with stuff can dump stuff into your director's loan account, and suddenly that can build up without you maybe even noticing because you weren't looking. And then, hey presto, you get a great big tax bill on it. So lots of reasons why this balance sheet is that final piece in the jigsaw that we really need to have a tight understanding of. So I said we're going to teach you how to be the boss of your balance sheet, how to actually use your balance sheet. Well, firstly, it's a good way of making sure that your bookkeeping is correct. Because if you are looking at the balance sheet and you're saying, oh, that's interesting, why has the capital gone up? Why have my fixed assets gone up this month? Or why has my corporation tax liability not moved for 3 months? It will, or let's say your VAT bill looks a bit weird, or your wage bill looks a bit weird. You can say, excuse me, what's going on here? It's a really good way to go like, what's that? What's that? Can you tell me what makes that figure up, please? Because often what happens in small companies where we haven't got qualified accountants is bookkeepers kind of dump stuff in places and they'll try and work it out later, or they'll leave it for the accountant to fix at year end. And all of those things can build up these black holes for us. Tracking your wealth, I mean, God, that's the biggest reason to use it, isn't it? Tracking our wealth, to say, oh my goodness me, every month I can see my balance sheets going up. I am building my financial freedom. I'm building my future as I go. Month by month, I can see it, as long as we know it's correct, of course. We can look for changes and trends in the figures, so we can see what figures are going up. We can see what our assets are worth. It's just a really great way to kind of have a handle on the whole kind of, it's the overview of your business, really. It's the whole picture. It's really good as well for looking at ratios, so things like debtor days, gearing that measures how much debt you've got as a percentage, and things like liquidity, which really measures how liquid your business is, so how good your working capital is, how much cash you've got to pay your bills, and really we want to have plenty of buffer in that, so we've got plenty of wriggle room, and we're not just always waiting to get paid so we can pay our suppliers. That's a really good way to measure that as well. Solvency, I've mentioned it before, say it again because it's so important. It tells us where our solvency is. And make sure that when you get your year end, or when it is your year end, that you get your year end figures to the accountant really quickly, and ask them to turn it round quickly. Often, I've been in a position where I've sent my year end off, the month after my year end, and I've waited 6 months while it's sat on their shelf. Now that's just not good enough. So make sure that you're really proactive with your accountant and say, I want my accounts back quickly. In fact, I've just had another client this week who we put their accounts in month 1, and they just filed them on the deadline last week. And they put a big adjustment through that we weren't expecting on the balance sheet, which was that caused a lot of problems. But that's just not okay. You know, accountants are there to work for you. Take control of that. Tell them when you want your year end turning around. And I will tell you right here categorically, it is not okay to get your year end back in month 8 or 9. It's not okay to get it back in month 5, 6 or 7. If you want to build financial freedom, you need to know quickly that your figures are correct. You want your year end back within 3 months. So if it's March year end, you want to be filing accounts by June. But the longer it goes on, you end up dragging it out and you've got to answer questions and queries months and months later. You can't remember what the answers are. So just good housekeeping, get it done quickly, only way to be. And just really look at it and think, what's sitting behind these figures? If there's £20,000 in accruals, hey, can you tell me what that is, please? You know, if there's money in your director loan account, excuse me, what's that? What have you put in my director's loan account? It is your director's loan account. It's your accruals figure. If you're VAT, we're going like, is that really our VAT bill? Crikey. Well, okay, show me what makes that up then. So just really pay attention to it and ask questions, because you'll learn loads by doing that. And the bottom line is, you are legally responsible for all of your financial information. You're legally responsible for your balance sheet. If something's gone wrong with it, they're going to come after you. Yes, you can go after the accountant as well, but fundamentally, you're liable for it. So I hope that has been a useful way to kind of dispel all the accountancy jargon and the myths, and to help you feel really empowered to want to really go and look at your balance sheet and understand the importance of keeping it up to date and accurate, knowing what it's saying, knowing what it's mean, and to know that when you look at it every month, you're tracking your wealth and you are building brick by brick by brick your financial freedom. So I'm just going to check in and see if we have any questions. Come on, all of you lovely people watching. Oh, you have got some comments. There we go. Oh, goodness me. Afternoon. Hello, hello, hello. Love my socks. Thank you. Good technical question. Thank you very much. Carl, while a profit and loss can easily be scrutinised, balance sheets seem to be able to hide all sorts of nonsense. Absolutely. How well can they be scrutinised? Well, by you, Carl, looking at that. Love my socks. Thank you. Let's just stop that. Good technical question. Thank you very much. Sorry, I can't get that. Stop that playing. Yes, you're right, Carl. There's a lot of nonsense can be on the balance sheet, which is why you looking at it, understanding it, tearing the numbers apart and asking, excuse me, how has my stock figure gone up by £20,000 this month? Where did that come from? Because guess what? Accountants and bookkeepers, they make all sorts of assumptions as well. And this is your money. It's your money they're making those assumptions with. So you really need to understand it. Andrew, hello, good to see you. Julie, I'm glad that's helpful for you. So, you like my jigsaw drawing? Thank you, Carl. So it really is, I cannot overestimate this enough. Owning your balance sheet, being the boss of your balance sheet, knowing that it's your balance sheet, not the accountant's balance sheet. It's just absolutely pivotal and critical to you if you want this financial freedom that we are talking about all the time. It's the wealth of your business, they're your numbers, it's your money, and you have got to understand it. So if there aren't any other questions, I am going to bid you a wonderful Friday afternoon. Have a great weekend, and I will see you all very soon. Bye.